It is July 25th, and this is, of course, the video log that takes 30,000 to a million. Today I'm going to try a different format. I'm going to try to structure this episode a little bit to see if I can make some improvements for y'all and for myself. So, first of all, what we're going to do is I'm going to do a market summary, followed by a account review of what's going on in my account. Then I'm going to have a finger pointing segment. We'll see if I can execute this, followed by a well articulated question. So I'm putting myself into a pressure situation to give you a well articulated question. So, first and foremost, we're diving into the market. So, I'm looking at the finviz.com stock heat map. Now, I'm not affiliated with anyone, by the way, so this is the 1 week performance. And some things that I'm noticing here is that the big players, of course, are gaining. The Googles, the Apples, the Amazons of the world. And what's hurting is things like energy, utilities, some more conservative plays here, basic materials, things like that. Basic materials are not doing horrible, but at least gold, the precious metal, is down, and some of the other companies, but it's not that bad. Financials are also kind of they're doing okay. And I think the main reason for that is that this trade that we've had going on in the last maybe 3, 4, 5 months since late last year of the tech long-term growth plays being undervalued relative to value stocks, if I can say that, is reversing. So we can see this kind of stabilization, or at least the market coming to an equilibrium that's been established from trends prior to last year's crazy action. So that's the 1 week performance, and I think day performance is also telling. One thing that you'll notice here, excuse me, I need to get rid of this advertisement. One thing you'll notice here is the Alibaba, PDD, JD, a lot of the Chinese growth stock took a very big hit. And that is because of China's decision to do away with for-profit tutoring companies. And I think that many companies got scared from potential fallouts, and some of the educational companies took a hit like 90% or something like that over a certain period of time, maybe as much as 60 or 70% in a day, which is kind of crazy. But some would say that this is kind of like not that surprising, and they saw it coming. Probably the downtrend 6 months from before now is a little bit of indicative of that some people saw the writing on the wall, but it finally hit, and now it did hit the wall, not just right on it, and it dropped straight down. I mean, maybe I can show you some of these stocks. I'm sitting at 167,000, by the way. What was it? TAL, was it? Yeah, I think TL is one of them. Look at this, 70% drop. 70%. Look at this weekly chart. Oh my goodness. Boom. Hits the wall. Drops dead. No dead cat bounce, that's for sure, on this stock. But you can see how it's been trending down over the last 6 months. So moving on back to markets. Let's see the 1 month trend here. You can see the reversal is pretty clear, especially by way of energy. Energy has been going down quite a bit. You can see minus 11, minus 12, minus 13.4 there. It seems like the energy companies are taking it on the chin. Financials also, banks, etc. Telecom services are neutral to lower. Tobacco is lower. Education lower. Beverages lower. Farm lower. Food lower. So everything value is low, and the tech's been back resuming its boom market. Okay, So that's what's going on in the markets. This is kind of a global picture, this heat map. So now I'm going to go into the account. This is now officially the account review version or portion of the video here. So what I'm going to do is I will show you all of my positions really quickly. I'm just going to scroll through them with my mouse, and you can see all the information that you will ever need is listed right here. You can see the ticker, the option contract strike price, whether it's a call or a put, the expiration date, number of contracts, whether it's a sell or a buy. And this on the right is the daily change in dollars and in percentage, by the way. So you can see all of my plays at the moment. Don't be fooled by these call sells here. This is just a little bit of my position. I'm going to scroll down, and you can feel free to pause the video at any moment to find out more information. Still have a lot of going on EBEX. I'm trying to harvest as much premium as I can from EBEX. Okay, so here are now my stock positions, my equities. Apple did exceptionally well, but this performance was offset in a very big way by the Chinese market, which went down in a horrific fashion. JD going down more than 5%, Alibaba almost 4% in one day. Feeling the fallout of these educational stocks. Everything else in the US market is doing okay, but I have lots of emerging market stuff, so that does not bode well. Okay, that I think completes my account review portion of the video here. If you're interested in the account tab, this is the margin used at the moment, $60,000. Total equity, $167,000. Money controlled, $227,600 and something and change. Then total return stocks, Apple number 1, Realty Income number 2, Visa number 3. Equity, Apple, the heaviest position in my account, followed by EBEX, and then Alibaba and JD.com, and then Realty Income. So this is everything that you may want to know on my account. Weekly performance, 1 month, 3 year, and 1 year, up 43%. I will not be showing the, fine, all-time chart, but it's really not relevant. If you look at this out of context, you'll feel like, okay, what the heck? So for the first part of the account, there was just zero money in it, and that's why there's only change of like $200. I really started taking this account, I want to say August 28, 2018, maybe somewhere in here. Yeah, some over here. So this is where I really took ownership of this account. I started doing something out of it halfway through the chart. Moving on to the next section, which would be the pointing finger section. So this is going to be experimental. All right, so I'm going to be pointing fingers. And today, obviously, since it's on the top of my mind, I am pointing finger at China. So, for those unfamiliar, China's regulators have been on a seemingly relentless crusade to rein in business practices through regulation, right? Acts such as halting IPOs, like Ant's IPO, restricting listings abroad, like those for Didi, banning for-profit tutoring, we just covered that, TAL, and anti-competitive practices, Alibaba and others, are just some of the more well-covered recent actions. The sentiment in Chinese markets is negative. From a roaring post-virus China boom to a painful 30-40% bear market in some of China's biggest, one has to ask if 1, it's over, and 2, is it time to buy in? Obviously, my answer is buy. However, only time will tell, of course, like always. If I and many others are right about the prospects of the fastest growing region in the world. The communist regime in China scares investors. This is understandable. Nobody's safe investing in jurisdictions that is a jurisdiction that is unpredictable to Western investors, that has an agenda and operates in different rules than what we're used to. I think what the question to be answered is should we be more afraid of inflated US valuations or China's political risk? Clearly, I'm taking on the political risk, so today I point a finger at China. There you go. This is my finger pointing segment of the video. And then I have a well articulated question for y'all to end. That's what I'm doing now, okay? Let me see how long this video is. Okay, 10 minutes. Perfect. So, the well articulated question phase. And I've been kind of struggling with this. I've been thinking about this for about a week, maybe. So here it goes. Whatever your preferred method of scalping the cream off the top of financial markets is, there's always seems to be some kind of error correcting mechanism that draws us to explain difficult situations with other methods and other arts belonging to other people with greater mastery of the matter. Perhaps you are a chartist, but what you know and have learned over the years suddenly stops working, and so you look. You look to others, you look to other disciplines to explain this anomaly that you experienced. Perhaps you attribute the irregular behavior to macro factors or sentiment readings. Perhaps the boogeyman is a market manipulator, or those damn market makers taking us all for a whirl. Or perhaps you're a value investor now finding yourself looking at charts and interpreting every word of the latest FOMC meeting, Federal Open Market Committee. So today's question begs, is the expansion of an investor's skills a natural progression leading toward a more well-rounded market participant, better armed against the waves and tides of markets? Or is embodying a master of one philosophy the true way, making every other discipline a distraction, tugging away at your mastery and weakening you against those same waves and tides? Your answer below. Peace out.